Welcome to the Mortgage Insider. I'm Stacy N. Stevens, licensed real estate broker and mortgage broker here in Florida, which means I sit on both sides of this transaction and I see what trips people up before they even realize it's coming. Today we're talking about something I call the smart tax paradox. And if you're self-employed or investing in real estate, this one's for you. Here's the situation. You spent years building a business, working with a great CPA, legally minimizing your tax bill. You are doing everything right. Then you go to buy a home or your next investment property, and suddenly that same strategy is working against you. The lender looks at your return and sees someone who barely made any money. That's the paradox. Your financial intelligence is being used against you. So let's break down why that happens and, more importantly, how to fix it. Traditional lenders, we're talking FHA, conventional, they operate under what's called a qualified mortgage framework. They're not looking at your bank account or your gross revenue. They're looking at a very specific number called qualifying income, and it comes straight off your tax return. That calculation can absolutely crush your borrowing power. If you have a Schedule C, they'll add back some non-cash expenses like depreciation. That helps a little. But if your income dipped at all last year, even because you reinvested in the business, they'll use that lower number. No averaging up, no explanation accepted. And for my investors specifically, this one really gets me. The Schedule E holdback is a silent killer most people don't know about. You could have a rental property performing beautifully, cash flowing every month. But after the underwriter subtracts taxes, insurance, and a mandatory 25% vacancy factor, that property shows a paper loss. And that paper loss counts against you. You built a profitable asset and the system penalizes you for it. Here's the good news, the market caught up. Not every loan works that way anymore. Non-QM loans, non-qualified mortgage, were built for exactly this situation. Two in particular. Bank statement loans look at your actual deposits over the last 12 to 24 months, not your tax return. For self-employed borrowers, this is often the most accurate picture of what you actually earn. DSCR loans, debt service coverage ratio, are the move for investors. This loan doesn't care about your personal income at all. It qualifies based on whether the property can cover its own payment. Your portfolio, your credit, your cash, not your Schedule C. Just know, DSCR is for investment properties only, not your primary home. Now here's what I really want you to hear before we wrap up. The decisions you make this tax season will affect your borrowing power for the next 18 months. I can't say that strongly enough. A 15-minute conversation with your mortgage broker before you file can change your entire outcome. Your CPA is doing their job, minimizing your income on paper for the IRS. Your mortgage broker is trying to do the opposite, maximize it for the lender. If those two aren't talking to each other, you're the one caught in the middle. You need to be the person who brings them together. A few quick moves to make right now. Talk to your mortgage broker before you file. Think carefully about aggressive write-offs like bonus depreciation if you're planning to buy in the next year or two. Understand the 2-year self-employment rule and know exactly what your paper income looks like. No surprises at the application. And when it comes to your approval story, here's how I think about it. Underwriters are detectives. They're not just looking at numbers, they're reading a story. They want to see consistency, growth, clean deposits, and reserves. Every document in your file should answer one question. Can this person still make this payment 5 years from now? Make the answer obvious. Credit still matters in non-QM. Most lenders want to see a 660 to 680, sometimes lower with a stronger down payment. But the income flexibility is real, and it changes the game for a lot of my clients. You don't have to choose between a smart tax strategy and the home or investment you want. You just have to plan in the right order and start earlier than you think. I'm Stacy N. Stevens. I'll see you at the closing table.